Month MPC meeting. Of course, I still have my guests in the studio to get their perspective on the outcome. Quite a lot to get through. Very interesting new dynamics in terms of how the central bank is trying to increase lending to the real sector. But let's start with the decision. As widely expected,
Yeah.
but were there any comments in there that suggest to you where the MPC may be going in the future?
No, definitely the fear of rising inflation, the fear of external imbalances and vulnerability is there. It's potent. It's more potent now than ever. We thought, we knew that this was coming. That is why some of us said should have dropped the rates two minutes ago, 3 minutes ago, and then begin to normalize at this time. You would have taken advantage. Now, what we're going to see is stall growth, kind of stasis as we are, all the way to the elections. Elections are not all the way, not until March. So, and what's going to happen? The external vulnerabilities will increase because there'll be outflows. The oil markets, I can bet you, the oil prices are going to go down because
it's one of the most difficult things to call.
I know, but the point is that the elections in the U.S. is November 4. You cannot have elections with the price of gasoline at $3 a gallon. So that's everything is going to be done to ensure that we moderate oil prices one way or the other. So if oil prices moderate at about 65 and production stays in there and there are outflows, we just have to manage expectations and stop talking about reserves. I think the reality is that we'll get through it, but the central bank is being very prudent here in saying that, look, wait a minute, don't do anything that is extraordinary at this time.
Tilo, I guess you are somewhat disappointed, but not surprised, I imagine, because I know you are calling for a lowering of rates, obviously.
Yeah, well, for me, while I think I said, I mentioned earlier that clearly I think the central bank has already put itself in a very difficult position of saying that until they see single-digit inflation at 9%, they're not going to react, which I think is rather unfortunate. And I think he mentioned the band of 6 to 9%. Now, the issues really, I mean, it's not surprising, but the issues or the disappointment for me is the fact that we're not growing our economy. And the impact of that is that if you can see what is happening with all these policies is that despite the fact that we have a stable exchange rate, there's problems with lending to the real sector, which obviously is manifesting itself now. And the central bank obviously is trying to find more innovative ways, as they're saying, of providing single-digit financing by looking at some innovative structures of releasing some sort of value on the CRR of banks, and the viability of that, investing in some commercial paper, which I don't think central banks should do. But I think that kind of tells you the challenges of trying to create a stimulus into the economy, because if the banking sector is not lending, the federal government of Nigeria's capital budget is not coming into the system to create the necessary stimulus, you have a deficit to finance, then of course you're stalling your economy. We're looking at 2.1% GDP growth at the end of last year. First quarter this year was 1.9, and we're projecting from Trading Economics 1.6 growth for second quarter. So the trajectory of your growth is clearly stalled, and we're looking at growth rates are beginning to look negative now, and we have to be very careful and mindful of that. We're clearly going to lose our status as the largest economy in Africa, and I think the example of these policies manifesting itself is to take a look at what happened with Procter & Gamble. Procter & Gamble invested $300 million in this country in a plant, fast-moving consumer good, looking at Nigeria's population of 180 million people, which is fast becoming a liability now instead of an asset. And you're finding Procter & Gamble now have had to shut down this factory, and it's easier for them to import these products instead of manufacturing them in Nigeria. Mm. So I think that should tell you something about the policies and the unemployment that has created. Right. So that really, for me, is my concern, and we have to take a look at that, because the inflationary, the spending from the elections, which we're expecting, I think for me is going to be a very critical stimulus and boost to our economy for growth, and we need that, and we need more of that.
Right. Okay, let me get to Jared. And Jared, your perspective on the outcome of this meeting, widely expected, your thoughts?
Yeah, it was pretty much widely expected. I agree with Telewa that it's, they could have surprised to the upside and done something about economic growth. From my perspective, I'm quite skeptical of these innovating lending type of structures. It seems like it's going to be quite difficult for banks to structure deals that will qualify for these types of structures, given the strict criteria about different sectors, particular payment structures. So I think it will be a very niche set of corporates and industries who will potentially benefit from this type of lending, and it won't really be a large-scale credit boost to the economy. That being said, it is a step in the right direction, and at least it's a move towards more easy monetary policy than restrictive monetary policy. I think looking at the voting structure of the MPC, where 3 members voted to hike interest rates, I think that was probably for me the most interesting feature of the press conference. It was quite a surprise, and it just demonstrates the extent to which the Central Bank of Nigeria is becoming very concerned about global factors. I think they are very much aware how fickle foreign investors are in this market, and that these sources of capital inflows are not permanent. They are yield-seeking, they are very aware of risks, and anecdotally from our side, speaking to foreign clients, we do see that they're starting to be concerns around election spending, concerns about political uncertainty moving into elections, and it's encouraging to see that the central bank is on top of these developments and is going to be willing to support and maintain positive real interest rates in order to make the markets attractive. So on that note, I think in order to see rates coming down, the only way that's going to be possible is when inflation does enter the 6 to 9% band set by the central bank, and obviously we'll have to wait to see what happens with food prices, which are the major risk to inflation, as mentioned by the governor. See what happens over the next few months, and it's most likely that they'll have to wait till after elections to begin cutting rates.
All right, let's now get into some of the innovation that was announced by the central bank governor, and they're looking to release some of those funds that the banks continue to say is a very crude approach to tightening, where banks are forced to leave money with the central bank at 0 interest rate. But the central bank now is offering that if they would lend that money for 7 years to some companies, they will be able to lend at 9% and get at least a 9% income from that. How do you see that working out?
I don't understand the logic behind that. You're giving me back my own money, but I assume a disproportionate amount of risk, right? I think that's credit rationing or credit control of some sort. I have a problem with any form of rationing and any form of controls. Let the market forces work. If you're going to put liquidity in there, that is not going to make people lend. If they're going to issue commercial papers are going to be bought by other. Commercial papers are disintermediation. What you're talking about is intermediation. That is, you're giving me back my deposit to lend. That's credit intermediation. Commercial papers or bonds that are issued that are bought by market players, market debt, is disintermediation. So I have a problem with that. But I also want to come back to something which we missed, which is if the target is that when inflation gets between 6 and 9, then you would reduce interest rates. When in fact the projections are that inflation at the end of 2018 is going to be about 13.2%, but it's going back up there. IMF says about 12.9, EIU says about 13.2, we think about 13.3. And in 2019, also higher, it's going to be higher double digit because of all of these vulnerabilities. It therefore means, if I'm to follow you logically, that until 2020, you are not going to see interest rates come down. So I think it's not good to tie the fact that interest rates will only come down when inflation comes between 6 and 9. If you said that if growth falls below a particular level, then you will need an interest rate reduction to stimulate growth and kind of credit infusion, then that is a more likely and more plausible parameter that will be used to determine when interest rate triggers are going to take place.
No, I think it's a very important point, and if only we could have some of the journalists ask that question. Is this the MPC saying categorically that if we do not see 6 to 9% inflation rate, there is no chance of a cut? But anyway, your perspective on this innovation about lending?
Well, first of all, I think the central bank have covered all the issues, but for me, this sort of things just shows the desperation of the fact that we're not able to lend and provide stimulus. So I think it's symptomatic of the problems or the what I'll say the fragility within the banking system to be able to provide the necessary credit for the stimulus in the economy. So the banking sector can't do it. The government budget can't do it. So what we're trying to do now is to try to find innovative ways of providing concessionary financing to banks to be able to create that stimulus. And I think we need to be very cautious about this approach because to be able to structure the financial instruments will not only be subjective but very difficult. And we also have to ask ourselves, what criteria will the central bank use to be able to invest in commercial paper? Obviously, are they going to take like a blue chip credit rating agencies to say, well, if a bond is not about this or a paper is not about the central bank will not invest in it. So we have to be very cautious. We're treading new grounds. But I think the problem is the fact that we need to get the banks right, sorted out. Maybe they need to recapitalize or maybe add more capital to the banks. They need to go out and look for more capital to be able to expand their balance sheets and become on stronger footing and be able to lend. But having said that, I think the central bank has touched on all the issues. But I think for me, the key really is GDP growth and to be able to empower Nigerians because our economy is not growing at the level of our population growth, which is 3%. So the Nigerian population of 180 million is fast becoming a liability instead of a big marketplace for corporates to come and invest in.
We have run out of time, but Jared, if you can just respond to this point. I'm not sure you're following the news flow, but earlier today we did see some defection from the opposition party from the ruling party to the opposition party in Nigeria's Senate. And effectively what we now have is that the ruling party is now a minority in the upper house of Nigeria's National Assembly. I want to get your perspective on how these type of dynamics impact foreign investor sentiment in terms of bringing their money to Nigeria right now.
Absolutely. As mentioned before, I think political uncertainty is front of mind for foreign investors. These types of developments are to be expected moving towards elections. I think, with both political parties, being not so well established, in the ruling party having been cobbled together in order to bring President Buhari's name onto the presidential ticket just before the previous elections. I think it is to be expected that there will be some uncertainty and some political frictions at this time of the cycle. Foreign investors are watching it very closely. We've had numerous questions around it, and it suggests that it will be quite a tightly contested election going into the beginning of next year. It's going to put foreign investors on the sidelines, and clearly the CBN is monitoring this very closely, and judging from the hawkish tone of this MPC statement, it looks like they will certainly be keeping an eye on activities of foreign investors in the investors and exporters window to see what type of outflows
Jaron,
we get.
I really have run out of time. So sorry to interject, Jaron, but we really have to end it there. Thank you so much for your perspective today, and that's our coverage of the third MPC decision in Nigeria this year. Many thanks to my guests. Of course, I've had Bismarck Rewani, the CEO at Financial Derivatives, Tilewa Adebajo is the CEO at CFG Advisory, and of course from Johannesburg, we've had Jaron Mearson, a derivatives trader at Rand Merchant Bank. And I am Wale Famarawa. Thank you for watching. Closing Bell East Africa comes up next.